Welcome, everybody. This is Buck Joffrey with the Wealth Formula podcast. And today I want to start out by reminding you once again that there is a website behind this podcast that we have, and it's called wealthformula.com. There's all sorts of goodies there for you to check out, including my best-selling book, 7 Secrets of Eternal Wealth, which you can download. You can also simply download that by texting me at 44222 and typing in Wealth Formula as one word. Again, that's 44222, Wealth Formula. Now, I also want to point out that there is another tremendous resource, which those who are participating, I think, would attest to, and that is the Wealth Formula Network. This is the forum, the community in which all Wealth Formula faithful communicate with one another, which includes a forum, a course, and an app now, which you can, by the way, anybody can download the app at iTunes or Stitcher. It's just Wealth Formula, but allows you to communicate with one another if you sign up for Wealth Formula Network. Now, you can check out the whole kit and caboodle, the whole deal there at wealthformularoadmap.com. But if you are a big fan of this show, if you like what we're talking about, and if you want to get in the inside, that's where you got to check it out. The people who are on that Wealth Formula Network particularly are fond of the bi-weekly mastermind calls that we have. And if you know anybody who's in it, I guarantee you they're going to tell you it is definitely a tremendous highlight of that whole thing. Not to mention this course and everything else. I mean, listen, check it out, wealthformularoadmap.com. Now, it's times like these that it's good to talk to others. Why? Because everywhere you turn, it seems like someone is talking about how the market could crash any day. I mean, as I write this, I'm sitting there today. I work out at the YMCA. Yes, I went with the fancy gym. I work out there. I've been trying to work out, and they have that screen up, so I read the subtitles because my headphones won't stay in my ears to listen to anything. So I'm looking, and it says that the Dow is plunging, right? It's as when I was watching this, it's like, I don't know what it's going to be like when you actually listen to this, but it was saying that the Dow was, that the Dow was falling, the Dow was taking a beating because of Trump's tough on China policy, tariffs, all that kind of good stuff, trade wars, rising interest rates, ballooned asset prices. You're hearing a lot about this in the news every day. Is this baby going to blow or what? It's hard to say. I mean, I don't know the answer to that. Last week we had chief economist of Fannie Mae on the show. He didn't know that either. And the funny thing is, the last time it really happened, back in 2007, people didn't really know it was going to happen. Then it happened. It was like overnight. Jim Rickards and Peter Schiff think we're in trouble. But when don't they think we're in trouble? I guess that's the question. Not that they're not smart. They're both super smart guys. But they're the types of guys who have been, who've been preaching the whole doom and gloom thing for the last 5-6 years. And if you've been sitting on the sidelines that long, you feel pretty foolish right now, right? The reality is that at any given time, we have no idea where or when this correction will be. Now, we do know one thing. We know that what goes up must come down, but we don't know when. That's all we know. We know it must come down, I think, right? As for when, I can tell you that whether it's the housing market or the stock market, the other will follow. That is the truth. I don't pretend that there is a, that the housing market, as much as I'm much more into that world of apartments and self-storage and all that stuff, that it doesn't get affected. It does. It's just, in different ways. And there's different ways to shield yourself by not buying on speculation necessarily, but buying on forcing equity and creating cash flow. But the markets do follow one another. There's no question about it, and that's the way it works. That's why you hear this term. You hear that the markets are correlated. Yes, they are, and that means they follow each other. And for the most part, that relates to all of the asset markets. And we'll see what happens in the next one. It may or may not affect the cryptocurrency market. I think that the last time I had Tika Tiwari on the show, he said that he didn't think it was correlated right now, but as institutional money starts pouring in there, it's hard to imagine that it doesn't become correlated, right? Because after all, what is correlation anyway? Well, part of it is that when markets start to drop, that people get into trouble and they start selling off assets. When they sell off assets, they become less valuable. And so, you may sell off one real estate asset to cover a margin call in the stock market. Similarly, it could end up being the case that people are selling off Bitcoin to pay off a margin call or, getting in trouble on a speculative real estate deal. That's just the nature of a correlated game. Now, does that mean you should stop investing? I don't think that is the case. I think investing in quality assets will eventually lead you to come out ahead. I think you could even say that to be the case if you were investing in quality assets in 2008, if you weren't following a speculative, thesis that even if you were investing in real estate and you were investing in quality assets in primary markets. I mean, look at Dallas. People were investing in Dallas. I mean, sure, the market went down a little bit, but overall people did just fine. On the other hand, in the secondary and tertiary markets where people thought they were pulling off more yield, well, I mean, that didn't turn out so good. And I think that that's what's going to happen again. Honestly, I just think, correlation, market correlation is something that's very difficult to dodge when things go down. But I think if you're in high quality assets and good markets, I think just plan on holding, and eventually chances are you'll be just fine. Now, on the other hand, what if it were possible to stay completely out of the line of fire, right? Completely out of the line of fire, to invest in something truly uncorrelated with any market. First of all, is it possible? Well, I think it is. And if it's possible, would it make sense to do so? I would argue that it is possible and it does make sense. That's why I'm an advocate for an asset class that few even know exists outside of Warren Buffett, Bill Gates, some hedge funds, maybe some multinational companies, banks, but not usually Joe Investor. But this asset class does exist, and it's one that few people know about, and it is backed by one of the few guarantees in life. What is, in fact, the only guarantee in life as of right now? It's death. Because taxes, Tom Wright has shown us that it isn't really all that necessary if you play your cards right. So in this week's episode of Wealth Formula Podcast, you are going to learn exactly how you can take part in this ultimate financial hedge. So when we come back to tell us all about that, Tim Wright of ASR.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Tim Wright. Tim is a senior partner at ASR, Alternative Investments, since 2007. That may sound familiar to you as Tim's been on the show before. ASR is in the business of life settlements. Now, there's a good chance you've never heard of that. And when you hear about it, it may come as a bit of a surprise to you that this asset class even exists. It certainly did that for me, and that's why and I got really interested in it since then. Tim has been on the show before, as I mentioned, and one of the reasons I wanted to get him back on the show is that we're really late in this economic cycle. We are now in the second longest expansion of GDP in U.S. history. For those of you who heard Doug Duncan on the show recently, and it, to a certain extent, some sort of correction is imminent. We don't know when, we don't know how severe, but it's imminent. It's just part of the cycle. So I thought it would be important to get Tim back on to talk about this particular asset classes, because I think it's appropriate for the time. So welcome back to the show, Tim.
Well, thanks for having me, Buck. I appreciate it. I always love to be a part of the podcast.
Yeah. So, Tim, first of all, why don't you remind our listeners what exactly a life settlement is, right? I mean, it's an unusual thing, and a lot of people are probably hearing that term for the first time.
Yeah, and we'll talk about why that is in a minute, but let me define it like you said. It's simply the sale of an existing life insurance policy to a third party at a discount to its face amount. So you have a person who has $1 million policy, they're 85 years old. Typically a life settlement would be somewhere between 80 and 90. They have this policy, they don't need it, they don't have a need for it, they can't afford it any longer, and they want to not let it lapse, but they go to sell it. And they might get 10 cents on the dollar, they might get 30 cents on the dollar, dependent upon life expectancy, their age, what type of policy that it is. And that gets sold to typically Wall Street will pick up a lot of these policies at an institutional level. We do it a little bit different so that your mid to high net worth client can invest right alongside them. But that's basically the gist of it. It's a very simple concept. It's been around for about 25 years. And that's what a life settlement is.
So just to circle back here a little bit, and help to get everybody sort of on the same page. We talk about permanent life insurance, whole life insurance, various products that we've even, talked about on this show. But the key here is that this is a permanent life insurance product. So unlike term insurance, which a lot of people have, they skip the whole or universal or whatever. These are policies typically that have a cash value associated with them. Is that correct? They're not term policies, or can you do that too?
We don't do term policies primarily because you get to a certain age, the price gets very expensive and they term out at 70 or 80.
Right.
So they are permanent life insurance policies, yes. Typically universal life policies.
Right. So basically what you're doing here, if I understand this correctly, I know I understand it correctly, but just to clarify, is that you've got somebody, say maybe they're 80 years old, and they've got this life insurance policy that they've been paying on for 50 years. And one day their kids are grown up, they might need some money, and they've really got a couple options. Either they say, well, and maybe they can't even afford their policy anymore, right?
Yeah, sure.
And they have a couple options. One is just to let it run out, which unfortunately a high proportion of people do. The second option is they have a cash value inherent to these things typically. Now, why would somebody instead of taking the cash value in a policy, say they've got $100,000 accumulated in that policy, why would they not just go back to their policy owner and say, hey, give me $100,000 now and let's just call it, let's just call it policy. Right. Why would they sell their policy?
Well, it's one of the cool things about life settlements is there's so many benefits to the insured. One of the benefits is that if you have cash value, you typically strip that cash value before you sell it. So you're getting the cash value and you're getting the value of selling it. The people, the investors, Wall Street, whoever's going to buy that policy, we're on the investment side, obviously, they want the death benefit. They're buying into the death benefit. So there may be a situation where the person, for tax purposes, says, let's keep the cash value inside the policy, and that will help reduce the cost overall. I'm going to get less cash. But typically what happens is the death benefit is stripped, and then we're buying the cash value is stripped, and we're buying the death benefit from the insured.
Well, that's interesting. So they get to keep that, and they actually will get more than just the cash value, right? I mean, how much typically more would they get?
Well, it's always going to be more than the cash value, and it's going to be somewhere between the cash value and the total death benefit. But depending on the life expectancy, which that's really what drives the pricing here on these policies, it's going to be somewhere between 10 and say 30 cents on the dollar. So if I have $1 million policy, I may get $300,000 of value given to me on a policy that I don't need anymore. I don't want, I can't afford. It's just a piece of paper and it means nothing to me. And this is one of the reasons that you have these 80 to 85-year-olds, 90-year-olds that love this option, because it's taking something they really don't have a use for anymore. They've outlived the usefulness and they're able to sell it. And, it obviously helps with a lot of expenses that seniors have.
Yeah. So one of the questions that when I tell people about this for the first time, and I remember I don't even know why I even bother with this, but occasionally go into like a doctor's forum, just to try to, talk to other doctors about what I'm doing. Of course, they all think I'm from Mars, and they don't like what I'm saying, whatever. But I talked about life settlements in general. One of the comments I frequently got in there is, "Yeah, I doubt that's legal." So, is it legal?
Yes, it's highly legal. Yes, it is. But we get that question a lot as well. Really why that comes about is people have never heard of it. So I think when people find something to be so foreign, they just automatically think that, oh, wow, this can't be legal. There's got to be some law against it. And in reality, not only is it legal, but there was a Supreme Court ruling back in 1911. So it's well over 100 years ago. It's called Grigsby versus Russell, that set the precedent that somebody could take their policy, just like their house or their car or their watch, treat it like property, gift it, give it away, sell it, whatever they want to do. And it took about 80 years, Buck, before the you could say industry kind of kicked in and realized that there was a market for this. I call that the insurance company's best kept secret.
Yeah.
And now today it's $50 to $75 billion industry.
What's interesting is, so it's an interesting Supreme Court case. I'm familiar with this because I was kind of curious about it. But Grigsby was a surgeon, and the patient was a patient of Mr. Bouchard.
Yeah.
This guy was already late on his insurance payments, and he was going to lose his policy anyway because he didn't have any money. He didn't have any money for surgery that he needed. So he went to this Dr. Grigsby, and he said, how about you do my surgery and you take my policy, and that way, you'll get value, when I die, more value than you're going to get for the price of the surgery. And I was going to lose this policy anyway because I can't pay for it.
Yeah.
So they did the deal. Of course, when he died, that's when the insurance companies were like, wait a second, what did this do?
You can't do that. Yeah.
You can't do that. And that was but it's a pretty cool story, actually. And
it is.
That's exactly what one of the things that I love about this industry is that it creates opportunities for people. It sort of unlocks an opportunity for liquidity for people who are pretty, who might be in dire straits, and they're going to lose a policy anyway. They need some help right now. And sometimes you're actually doing people a big favor in actually coming in and buying these things. So, give us an example of, you talked about, why don't we know about this stuff, right? Because it sounds like some big guns are involved with this, Berkshire Hathaway, Bill Gates. So how has this thing evolved? This over 100 years ago when the legality of this thing is established. Why did it take so long? Who got involved? And how has this thing ultimately just moved forward?
Yeah, the quick history of it was back in the late 80s, early 90s, where the AIDS epidemic really kicked in, and it was just a death sentence, unfortunately, for so many young people. And there were investors that came out and said, well, wait a minute, a lot of these people have these small $50,000 life insurance policies. They need money. Let's go ahead and buy their policy from them, give them a cash infusion to live out the remaining years of their life in dignity. And that's really how it started. It started out as viaticals, and viatical is basically a policy or someone that has less than 2 years to live. Of course, life settlements are not that today. It's evolved. But basically, that was the predecessor of life settlements. And about 1995, 1996, you had the drugs that came out to prolong life. Well, that made it very difficult to predict life expectancy. So all of a sudden, the viatical industry, which was a very good industry for the insureds and for the investors, pretty much dried up because there wasn't any new money coming into it because of the life expectancy issue. Well, there were some smart people that sat down. Some of them were on Wall Street, some of them were off Wall Street, and they basically said, well, wait a minute, we're doing the same underwriting, but let's go ahead and look at 80 to 90-year-old life insureds, and let's look at policies that are $1 million to $10 million. And so basically that's how it started. The challenge was most people, really no one who had those types of policies knew anything about it. So it took between 97 and really probably 2007, about 10 years, for a brokerage side of the industry to kick in, where you had people who were out educating people on the fact that you could sell your policy. Now you see TV commercials on it all.
Like Coventry and all that.
Yeah.
But so were the institutional guys, were they in it already, or was this really the birth of the entire industry?
The viatical industry really never saw many institutional players in it. It was smaller, high net worth individuals that were going in to kind of save the day with the viaticals. About 97, 98 is when you started to see insurance companies come in and actually buy portfolios of these policies. Now, of course, they weren't buying the portfolios on their own company. They were buying it on multiple other companies to hedge from their policies being purchased. And coincidentally, insurance companies are the largest investors in this industry altogether, which is...
Well, that tells you something, right? And on top of that, you got, I read that Berkshire Hathaway is a $600 million per year. And what they're doing is interesting too. I found it interesting is that they look at it not only as, buying policies and waiting for the expiration, but they're actually doing arbitrage, right?
Yeah.
They have, if they buy a policy from somebody who's 60, they may sell it 5 years later, somebody who's 65 who's developed a health problem.
Right.
So it's a really interesting asset class. I mean, all these different things that you could do with it. Now let's go back to a little bit to that the 90s and what happened there, because I think in many regards, when I learned about this concept of life settlements, Tim and I, we've talked about this before. I thought, well, gosh, this is an absolute no-brainer. I don't understand why, again, like a lot of things I say, is why didn't anybody tell me that I could do this before?
Right.
Then I started Googling this, viaticals and life settlements, and viaticals came up. And there was a lot of negativity because of a lot of fraudulent stuff that occurred.
Yes.
Can you talk about what happened? And because I know specifically, I've even had some, I've had some people email me telling me about their experiences back in the 90s with this. Can you address that a little bit?
Yeah, I definitely can. Our company's been around for 13 years. I've personally been involved with this for 11. And it was the Wild West back in the 90s. Of course, we started in 05. We weren't open in the 90s, but it was the Wild West. And so you had very little regulation. States were trying to figure it out. The federal government was trying to figure it out. So there was just a lot of confusion. And unfortunately, when any new asset class starts, there's going to be some bad actors involved in that. And there was some fraud. There was some, in fact, I think if you went on American Greed, of course, you can see things on stockbrokers and real estate and, every asset class under the sun, but there's a life settlement American Greed there as well. And we're sad that happened, but we're thankful in kind of an odd way that it did happen, because that's what spawned regulation. That's what spawned the oversight that exists today. So it's pretty rare in today's market that you're seeing companies most companies are quite transparent. They have the experience. The Wild West days are absolutely gone. But with that said, there's different companies out there that do this, and those are questions that need to be asked. How transparent are you? What is your experience level? What's your track record? So we're thankful for those days, because it's gotten to us to a point where we really are today.
Yeah, along that lines, I'll say that it took me a long time to get behind one particular company to do this, because I did feel like there was I don't think any the groups that I looked at were not doing anything flagrantly, fraudulent or anything like that, but there was still fairly loosey-goosey in a lot of ways that I didn't feel comfortable with. Can you talk about the role of, one thing that ASR does is they buy policies through life settlement providers. Talk about that process, because that to me was a big part of why I feel safe with this type of investing now, as opposed to, we're not knocking on people's doors and saying, hey, can I have a policy? You want to sell your policy? That's what some of these fraudulent things sounded like. But what is this policy? And tell us about the formal acquisition process and everything that's involved with that can make us feel that might give us some sense and comfort about going through this process with you.
Yeah, and I don't want to do that, but if I could just jump back just for a moment and just address something you just said, because I think it's really important.
Yeah.
You're looking at all these companies, and what company are you going to work with? And the thing that we pride ourselves with so much on, and this, Buck, we've talked about this so much, is the level of transparency. And I want to define that just for a second, because when you're in the life settlement business, there's things like life expectancy certificates. And we believe that anything that we see, our investors should be able to see. And the difference between some companies out there is it's almost like hey, trust me, we do it our way, and there's this black box over here. We're not going to tell you what goes on in it. And in our world, we say, listen, we have closing documents. We want you to see those. We have beneficiary and ownership sign-off documents. We want you to see those. We want you to see the life expectancy certificates. We want you to see the ROI illustrations. We want you to see our annual audit that gets done on our fund. And that's, to us, really important. And there are companies out there today that probably could do that, elect not to do that. And so I just wanted to address, transparency is this big word, but let's talk specifically about our company, and there is some real fundamental differences. So that's that. In terms of the process, to answer your question, it's a pretty interesting process. And so if somebody is 85 and they have an insurance policy they no longer need or want, most of the time, these are pretty sophisticated individuals. Like you said, we're not knocking on people's doors, or we're not on street corners talking to old ladies or old men. These are financial decisions that people are making. They're typically very wealthy individuals, and they come to a point they don't need it anymore. Well, typically it's a CPA or a financial advisor that looks at Mr. Jones and says, you know what, this is money that you don't need to spend any longer. So at that point, they go to a life settlement broker, which is not on the side that we're on. It's the other side of the fence, I call it. That life settlement broker then looks at the policy and determines, is this truly a sellable policy? What's the age? What's the life expectancy? What kind of provisions does it have in the policy? So they do kind of a preliminary analysis on it. And then at that point, they will say, well, listen, this is probably where the market will be. The market is like real estate. It's whatever the market will bear, but the broker can kind of give them an idea, just like a real estate broker could. So if the person's agreeable to that, then they'll go to market. And now they go to what's called a life settlement provider, which is not us. It's a provider is like the title company in real estate, right? They're kind of the market maker in a sense. They're going to have all the access to all the people who want to buy policies. That might be institutions. It might be individual wealthy people who want to buy policies. It might be companies like us who operate funds, and we want to basically buy policies to purchase into the fund. And so on the other side, where we are basically going to providers all around the country. There's about 20 providers. We work with probably 5 on a consistent basis. And we tell the providers, listen, we want this type of buy box. A buy box meaning we have an age, a type of policy, a life expectancy, all the particulars. And when they see those types of policies, we then get to see those policies that are available. And then we do our analysis and we determine, is this going to work? And if it does, then we start the negotiation process. That doesn't commit us to it. We basically come to terms on price, and then we do our analysis. And the provider does a financial underwriting that's quite extensive. We would never buy a policy without using a financial underwriter like the provider. They have E&O coverage, so if they did something wrong, that would be covered. But that's a really important part, to make sure that there's no fraud in the insurance policy, to make sure that it's beyond the contestability period. There's about 30 things they check for to determine, is this a policy that will be a successful policy in terms of paying out.
Because and that sort of leads me to the idea of what are the risks, right? And when I started looking at that, one of the obvious ones is longevity. But other than that, one of the things I was looking at is, okay, the real risk here is that somehow other than longevity, is that that this policy somehow doesn't pay out, or the company doesn't, the fund doesn't do what it says it's going to do. So how do you mitigate against these various risks?
Yeah, so longevity and illiquidity are the main risks. But if you're talking about the risk of, will this policy pay off, let's talk about that. Yeah. It all starts with the provider doing the financial underwriting to ensure that everything is what it says it is. When the person passes away, there'll be a death claim, and it'll pay out. So if you believe, and I know you do, but if anyone believes that their life insurance policy will pay off when they die or a spouse dies, then you really should have the same conviction and belief that when a life settlement policy basically matures, we call it a maturity, then the same thing will absolutely happen. So the way that we know that is we're only dealing with top-rated life insurance companies. And you could say, well, what if the insurance company just decides not to pay off? Well, that would be catastrophic for AXA or Lincoln Financial or John Hancock. It would be catastrophic because the insurance companies have built their reputation over hundreds of years for doing what? For paying on their death claims. Now, they still are massively profitable because 90% of all policies, for the most part, when you include term and all policies, they do roll over and they lapse at some point. But with ours, it's not going to lapse. So it has to pay off. And if it didn't pay off, it would be catastrophic for the reputation of the insurance companies.
Yeah. And the idea of the insurance companies not paying off is not really something that's legitimate. Basically, I think I heard somewhere that in terms of claims, legitimate claims of death, there's never been a recorded case where it was not paid out.
Right.
I understand people think sometimes, well, what about suicide? Well, I was shocked to realize that in most states, after 2 years, it doesn't matter. There's really nothing that matters. It could be suicide. It could be anything. That basically after 2 years, they got to pay.
That's right.
And so that's really not a big part of the risk element. So, getting back to some of the other things that, you guys do to mitigate the other various risks to an investor, maybe you could kind of talk about the risks and mitigation.
Yeah. So one of the big ones is life insurance premiums, right? So if anybody that's watching, listening to this knows that if I own life insurance, I have to pay premiums monthly, quarterly, annually. And there's no difference here with life insurance, life settlements. So the way that we mitigate the premiums, in other words, we we reduce the likelihood of a client coming out of pocket down the road is we escrow typically up to the life expectancy of the insured. So if the policy or the insured's 85 and they have a 5-year life expectancy, we'll typically escrow 4 or 5 years built into the cost of this policy right up front. Then what we do is when there is a maturity, or again, we use that term loosely when there's a death, what we'll do is we will hold back at least 10% of the current death benefit. So let's say our fund is $25 million. The first policy matures and it's a $5 million death benefit. So now the death benefit is $20 million. We need at least $2 million in that premium reserve before we will do a distribution to our investors. That's critical, because if we paid it out all the time without that reserve, what we're going to obviously have to do is go back to our investors and collect premiums. So we're, knock on wood, in the 6 funds that we have operating right now, we've never had to go back to investors. We want to continue that trend. We also have other options before we need to do that, like selling a policy in the fund. We can do that. So there's some things that we can do to mitigate that risk that someone would have to come out of their own pocket.
When you look at this, market, this asset class, I mean, it's in its infancy, and right now, for something so safe, I mean, it's the numbers. If you look at London School study that I've sent to a number of people, the numbers are pretty good. Now, I would expect, though, based on the sort of nature of this, I mean, this is a very secure type investment, that the yields are being as good as they are may not last in the future. Do you expect that to be the case as more and more people catch on to the fact that they can invest this way?
I think that there's some validity to that, but I will tell you, in the 10 years that 11 years I've been involved in it, 13 since ASR has been involved, we've seen a little bit of a decline, but surprisingly not that much. And I would also tell you that when you invest today and you lock into a number of funds or policies, the rate is what the rate is, right? And so if we were concerned with, let's say 5 years down the road that the returns drop off 3 or 5%, that won't affect our current portfolio. Right. It may affect how we buy them down the road, but not today.
Yeah,
that's one point.
In some ways, what I was trying to get at there is, it's something that, to me, it's an opportunity right now, potentially, to look at and say, well, if we're at the top of the cycle, and if there's recession coming, and I want to deploy some capital to hedge the economy, so to speak, knowing that yields are probably not ever going to get any better than they are now.
Right.
Because, I mean, it's relatively, there's not that many. There's a lot of people listening to this podcast who've never heard of this before, and these are a lot of sophisticated investors.
Sure.
Knowing that ultimately can drive down future yields, so it might be worth looking into now. So, Tim, I do want to thank you for being on the show today and giving us some sense. Yeah. Specifically because of where we are in the economy and the role that this plays in it. And I just want to let everyone know that I do have a webinar that you can check out if you're really interested in this. And obviously, I got really interested in this, and have been working with Tim and ASR. You can watch that webinar that I did, which goes into a lot more detail on this at hedgetheeconomy.com. Again, that's hedgetheeconomy.com. Not trying to be settled there at all, right? So, Tim, again, I want to thank you for being on the show, and hope to have you on again soon.
Yeah, absolutely. Buck, can I just say one thing before we wrap up? And I just realized that it hasn't been said yet. And one of the biggest advantages, and maybe why your folks are listening to this, you talk about hedge the economy. The number one reason our investors, we've done over $1 billion of policies in the last 13 years. Number one reason is that they love the fact that this is uncorrelated to everything you're talking about.
Right.
Stocks and bonds and mutual funds and real estate, all the things that are correlated, which, by the way, well over 90% of most people's portfolio is attached some way to the economy. Life settlements aren't.
Yep.
And so it's a way, and you perfectly put it, hedge the economy. It is a way to hedge the economy and hedge the portfolio. So I just want to make sure that really people understand where we are here in terms of where this asset class belongs.
That's right. And, just to confirm that as a physician, which I am, death is not going anywhere anytime soon.
No.
So, especially when you're already, 80 and have multiple health problems. So that's the, that's really what this whole asset class is all about. So thanks for adding that, Tim. And again, thanks for being on the show.
Absolutely. Thank you.
We'll be right back.
Welcome back to the show, everyone. I hope you enjoyed that conversation with Tim Wright. Now, if you're interested, again, in learning about life settlements, and make sure to check out this webinar at hedgetheeconomy.com that I did. It may not be for you, it may or may not be something for you, but if nothing else, I think you'll be entertained, because it's, it's a fun little educational piece, and I go through some real policies of past funds and show exactly how it works. Now, again, just to be clear, this is a great hedge the economy, but I don't want to be doom and gloom. I just don't like that kind of brand of rhetoric. I don't think it serves anyone well. But who knows what will happen with this economy? And if there's a correction or a recession, maybe it won't even be that bad. Maybe it'll be just some explosions out in the Wall Street hills that most of us won't even really be affected by in Main Street. Who knows? And then on the other hand, maybe it really is a cataclysmic event. One thing I will say is that pay attention, though, to this whole notion of this demographic cliff, which virtually every economist I've spoken to believes is going to happen, which is in the 2027 range, and it's just a confluence of demographics and things like Medicare and all those things kind of coming together, and a lot of people are predicting some kind of major recession, depression type event. That's a different story, though. That's based on demographics, and so that's something to keep in mind. But for now, this might be something to think about, right? This might be something to say, hey, maybe it makes sense to take, a percent, maybe 5% or 10% or whatever of your investable assets into some place that's completely uncorrelated. So again, check out hedgetheeconomy.com. Now, I want to take this chance once again before I go to remind you to download that Wealth Formula app, okay? It's going to have all sorts of cool stuff on it. In fact, I think Phil put something on there right now that allows you to put my head on all sorts of different bodies and things like that. And so I didn't sanction that, but so it is what it is. Anyway, also remember from the app or from the website to make sure to leave us a 5-star review on iTunes. It certainly helps with the show, helps us continue to attract incredible talent to this show. That's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.